Hi, Ben Kingsley here with my RBA and economic update for November. And throughout the past couple of months, the RBA has been signalling to the marketplace that they were interested in putting more monetary stimulus in play. And that's exactly what they did today at their RBA meeting, where for the 11th time since 1990, they made an official cash rate movement. So what did they do? They moved the cash rate down from 0.25 of 1% down to 0.1 of 1%. So that's 15 basis points that they've moved the cash rate down to this now record low level. So now the big question turns to the banks in terms of what are they prepared to do? So are they going to carry forward that 15 basis points cut and provide their lenders, so their lenders, the people who are borrowing money from them, with a full 15 basis points, or are they going to adjust that slightly to maybe 10 basis points or even 5, or some may not move at all? So we do turn our attentions in terms of what the banks are going to do over the next couple of days, because they do have obviously depositors as well that they've got to consider in terms of getting that balance right. Now that's what's happening for the household. But what we really wanted to focus in on in regards to the RBA announcement today was what they're doing around government and business lending. That's right. The focus is on jobs, jobs, jobs. And the RBA has certainly tweaked that in terms of what they're doing in the bond market. So they also made some adjustments with the bond market, and they've seen those changes being put in place. Now, what we're going to be seeing here is, why have they done that? Well, it's all about QE. So what is QE? Quantitative easing. And what they've done is they've adjusted the 3-year bond rate, and they've also played longer down the curve to try and make sure they do critical things. And that is make sure that there's ample liquidity in the marketplace, so the markets are operating correctly. And they're also trying to reduce the costs of borrowings to governments and ultimately to business as well. So that's what we've seen doing, because what has been clear throughout this pandemic is small business has been impacted the most during these times. And we've seen the federal government stimulus in terms of their playbook in regards to what they did with their fiscal policy. And now we're starting to see the RBA tweak their monetary policy playbook to allow that to try and get that confidence and stimulation back into the market. And really what they've been talking about is kickstarting the economy, given that we are seeing this opening up of all states and territories, which includes Victoria. So that's what's been happening in terms of the RBA. I've got something more to add later on in my close around what the message from Governor Lowe is. But in terms of what we're seeing around RBA, that's the movements that we've seen today. So let's now have a look at the economic story around the globe, and also then we'll turn our attentions into Australia. And you can't look globally without obviously talking about the big news, which is the health crisis around COVID-19 and the wave of infections that continues to grow. So we are seeing daily cases grow by over 500,000 a day. There's been 46.5 million overall cases and over 1.2 million deaths. So a very challenging time. We've seen America getting close to 100,000 cases on a daily basis. And we're also seeing some of the larger nations and economic powerhouses in Europe, such as Germany, France, the United Kingdom, also going into some form of stage of lockdown. So that will be the challenge in terms of what's going to be happening as they move into their winter and cooler months. So until we see a vaccine, we're going to obviously be challenged by these wave of events where we go into lockdown so we can get in control of those. So that's one interesting thing. The other interesting observation around this third wave is that the daily death rates have actually been relatively stable. So even though we're seeing increased numbers, and that's got a lot to do with what's been happening around the work that's been done on treatment programs, and also potentially the age group of people who have been contracting the virus. So we haven't seen that death rate also go as high as following the wave of those infections. Now, when we actually talk about that from an economic point of view, we did see last month that the International Monetary Fund reported that there was less pessimistic outlook for global growth. So they adjusted their 2020 forecast, where GDP will shrink by only 4.4% this year compared to their June forecast, where they thought that the global economy was going to shrink by 5.2%. Now, that said, the contraction would still be deepest than the Great Depression, so it's still a significant global contraction. And their forecast for 2021 is that growth of 5.2% for the year, as opposed to previously their forecast back in June was for 5.4% growth. So a slight adjustment there until we see what's going to happen again on the vaccine front and that rollout of that particular program. So now let's turn our attention to the United States, and we obviously have one of the biggest presidential elections, which is also set down for Tuesday, the 2nd of November, our Wednesday. So we're seeing the polls show that Joe Biden is ahead of Donald Trump. So we'll see how that plays out. It obviously is a nation that's very divided. So there is, from an economic point of view, some concerns that may flow into the marketplaces around disturbances, violence, a messy outcome that may play out post-election. So that is something that should be of concern to the marketplaces. So we'll see what happens in regards to the equity markets. And that also plays into the broader global equity markets in terms of what we're seeing around the coronavirus and the volatility that we're also seeing play out at the moment as a lot of these economies move into stages of lockdown and closures. In terms of the economic news out of the US, we did see that the US GDP did soar to an annualized rate of 33.1% in the September quarter, to a historically annualized, that's after a historical fall of 31.4% in the June quarter. Now, GDP is still 3.5% below its pandemic peak, but we are definitely starting to see some signs of recovery in that economy. And so let's focus on what they are. The main contributors were personal consumption, which was up 40.7%, particularly around durable goods, up 82.2%. Private investment was also important at 83% growth, mainly lifted by residential investment, 59.3% growth, and government spending in trade balance of negative contributions. So that basically led to that significant GDP bounce. And we talk about a V-shaped recovery, that's what it looks like, but still a little bit to go in terms of getting back to where it was pre-pandemic. The market services PMI index rose to a solid 56 reading from the preliminary October figures, and the manufacturing PMI indexed edged higher at 53.3, remembering that anything above 50 is expansion rather than contractions. And both of these points further to a growth in the economy after the setback of the COVID-19. In terms of the latest data, the weekly data around the US initial jobless claims fell more than was expected and did surprise the marketplace with its resilience for the US labour markets. So new filings decreased from a revised 898,000 down to 787,000, which was also important numbers. Retail sales rose 1.9% for the month of August, which was well above consensus median for only a 0.8% rise. And this follows a 0.6% gain in August. So my correction, sorry, that was a September number. So that was a strong gain. Now, this is the fifth straight month that retail sales growth, it was growing, and that's a positive for that marketplace because consumer spending and consumer consumption is the driving force of the US economy. So we are seeing some positive economic data right in the midst of obviously the challenges that we're seeing around the increased cases in the third wave of infections that are happening in the US. Let's look at China quickly. GDP for September quarter was up 4.9%. On the same quarter of last year, it was 3.2%. So definitely showing some growth. Industrial production rose 6.9% for the same period, and retail sales are up 3.3% for the same period. So good positive numbers out of a country that is well on top of its coronavirus issues. Inflation in China, like most parts of the world, is weak. So we're definitely seeing, sort of softer inflationary numbers there. Producer prices rose by 0.1% in September and contracted by 2.1% for the year to September. The consumer price index overall rose by 1.7% in the year to September, which is the slowest pace since February of 2019. China's servicing purchases managers index, their PMI, rose for the 5th consecutive month in August, rising to 54.8, from those figures that we saw at 54% in that month prior. The other thing that was also interesting that came out of the data and the economic story out of China was the Communist Party's release of more details around their 5-year economic plan and their focus on high quality sustainable growth. So they vow to transform the economy into a tech powerhouse with robust domestic marketplace focus. So that means they're suggesting to look internally rather than their main focus, which has predominantly been exports. So that is a definite shift in terms of where they see their future growth coming from in terms of that. Rounding out our look, let's look at Europe. Well, the recovery in economic confidence came to a halt in October. The index was flat for September with a reading of 90.9. So again, more pessimist than optimist. And that was amid the fears of a new lockdown measure, which has now been introduced, as we talked about earlier. The Eurozone PMI rose to 54.4 in preliminary October numbers, up from 53.7 in September, but that momentum is starting to wane. In terms of, at the same time, the services PMI index, so we saw the production PMI index up, but the services PM index has fell from 46.2 down from 48 reading in September. Consumer confidence in the Eurozone was also weak. The index in October dipped down to negative 15.5 from a negative 13.9 in September. So that is slipping away. Pre-COVID, the index stood at negative 8.1. Now, in the midst of the crisis, it was negative 22. So it's still an improvement of that. And then it rose to negative 13.9, which has been the best, but it has since fallen away in that October reading. So more broadly speaking, we do have some headwinds globally in terms of our economic outlook and challenges. So that's something that we need to be mindful of. What happens in the US is also going to play into that in terms of, how well people accept the decision of the majority of people in the voting that happens in that particular election. Now, turning our attention to the Australian market, well, compared to what is happening globally, you know what? Once again, Australia seems to be punching above its weight. The island nation that is Australia is looking well placed in terms of handling the health crisis. Victoria has done a great job. The Victorian people have done a great job in keeping the numbers low, and that's led to the opening. And so now we have each sector of the economy and each state of the economy in probably different phases of their opening, but ultimately all marketplaces opening, and hopefully we'll see more of that happen as we get to that Christmas New Year period. In terms of the inflation and CPI index, the headline inflation number rose by 1.6% in the September quarter. Now, this is the largest increase in the series since June quarter of 2006, when the quarterly CPI rose by 1.7. Now, what caused that was simple. Childcare was free for a period of time. It was then now dropped. So now childcare came back into the numbers. And the other thing that also rose significantly with petrol prices during that period, as we did see the global oil price go up as economies did open up during that sort of, April to August period. So that was the rise in the headline inflation. But you've got to remember that the RBA looks at the underlying inflation rate, not necessarily the headline inflation rate. So when we look at that, the underlying inflation rate rose only by 0.4 of 1%, and the annualized rate is just 1.2%. So that is clearly below the 2 to 3% target range. In terms of some other interesting feedback that we got from Governor Lowe and the RBA this past month was around their focus in language changes, which was shifting away from the focus on forecasting inflation in terms of before they move on the cash rate and changes to monetary policy to the actual inflation rate. So what does this mean? It means that once the actual inflation rate gets comfortably between the 2 to 3% band, then they won't be moving the cash rate. So this confirms to everyone that the cash rate is going to be on hold for a few years to come. Most economists talking about at least 3 years before we start to see that inflation, not forecast inflation, but actual inflation in a comfortable bandwidth of that 2 to 3%. In terms of the Australian Bureau of Statistics released their 9th edition of their Business Impact Survey, which led for interesting reading. The survey was conducted between October 9 and 15, and the focus of the questions for this one was really around financial position and funding positions for businesses. The survey highlighted that businesses remained cautious in October, although were marginally more optimistic than the similar survey they did back in July. Small businesses continue to bear the brunt of the economic impact from COVID-19. They reported the largest expected falls in revenue, as well as the largest expected increase in operational costs compared to a result of some of the larger size firms that were in the survey. In summary, about 20% of the larger and medium-sized businesses reported increase in headcount, which is positive, although most firms, including the small ones, indicated no change to employment. So they're holding on to their employees. The two most commonly cited reasons for seeking additional credit were for financing operating expenses. 60% of larger business and 73% of smaller business talked about just financing the day-to-day. And the other main reason was capital expenditure, which 48% of medium-sized businesses were focusing in on. Because when you're capital expending, basically what you're doing there is you're investing, and that means hopefully more jobs. Now, of the 73% surveyed in regards to whether they needed funds, the reason why they said they don't need funds was because they had sufficient funds to keep operating. So that's interesting. Now, if I round out the survey results, only 11% of businesses indicated not being able to meet repayment costs, and 13 expected to have their credit requests decline. So that's basically sort of saying about 1 out of 10 is in a situation where they're struggling. So we need to obviously improve that, but 1 out of 10 is not a significant number overall. All right, let's talk about unemployment, job ads, those types of things that we're seeing here. Firstly, unemployment, according to Treasury, because remember the unemployment rates are a little bit hard to read at the moment, that the effective unemployment rate, including people working 0 hours on JobKeeper, is about 9.5%. And in Victoria, prior to the recent reopening we've had in the last couple of days, that was sitting at around 14%. The overall unemployment rate in Australia rose slightly to 6.9% in September. The economy lost 29,500 jobs as part of the health crisis, and that was slightly up on the 6.8% unemployment rate reading that we saw in August. But remember, the effective unemployment rate is probably where we're at, which is around that 9.5%. Full-time unemployment decreased by 20,100 jobs to 8.5 million people. Part-time employment fell by 9,400 to 4 million people. The overall participation rate across Australia slipped to 64.8% from 64.9%. But the number of hours worked, which remember what the RBA was saying, that's what they want to keep focusing on. There was a positive across the country, which increased by 0.5%. Now, let's take a little deeper dive into some of the data showing payroll jobs across Australia decreased from the midst of middle March. So most job losses occurred in Victoria, 7.7%, followed by Tasmania, 4.5%, ATC, 4.3%. And what areas were they in? Accommodation and food services, 17.4%, arts and recreational services, 12.9% down were the weaker sectors, while finance and insurance services, including businesses like ours who have actually been employing, were up 2.2%, public administration and safety up 2.4%, with the jobs created over that period. So that's where we see the jobs data. In terms of the ANZ Australian job ads, which was released yesterday, shows a rise of 9.4% month on month in October, following an upwardly revised 8.3% in September. So that is positive signs that we are seeing more job ads start to hit the airwaves. But we are still some way off being back to where we were pre-pandemic levels, where the number is still 13.5% below that February reading that we had earlier in the year, but still positive signs. Talking about positive signs, consumer confidence and sentiment. The Westpac Melbourne Institute Index of Consumer Sentiment staged a very strong comeback following the federal budget. The index rose 11.9% in October to 105, showing more people are optimistic than pessimistic. And this is the highest reading since July of 2018, so even pre-pandemic. All states saw a lift in consumer confidence. All states are now reading above or at the 100 mark for the first time since February of 2019. Now, one sub-index in here, which we keep an eye on, obviously in the property space, is a time to buy a house index rose 10.6% to its highest levels since September of 2019. And the increases were all states. So reading those increases now, we see New South Wales at 120.4, Victoria at 118.0, Queensland at 118.6, South Australia at 131.1, and rounding out those big numbers, Western Australia, the index sits at 138. So real confidence in the property market there. If we then also get a reading from the ANZ Roy Morgan Consumer Confidence Index, we see also an increase in the weekly read of 1.6 points to 99.7. And that measurement was from the 24th and 25th of October reading. And it was the 8th straight increase that we've seen come out of those numbers. And that is a real positive because it also now sits only 10.7% below the year ago compared to the October reading that we had in 26-27 of 2019. And it's now 6.5% above the 2020 weekly reading of 94.4 that we got back in mid-March, which was the weakest reading during the pandemic. Overall, we can expect sentiment to also improve into even more positive territory, given Victoria is now out of the lockdown, and we are now starting to see those tax cuts arrive in everyone's pay packets. So that's also important to note in regards to that. Moving our attention to retail spending, our retail spending fell 1.5% in September, according to the preliminary estimates. Retail sales continue to bounce around during this pandemic, but they still sit 5.2% higher year on year, as we have definitely been spending locally, as we haven't been able to travel internationally. In terms of private credit, this is also an interesting story here. Private credit sector increased by 0.1 in September, ending a 4-month streak of declines. The annual rate now sits at 2%. Now it's the lowest since February of 2010. So still sluggish private credit. There's not confidence hasn't flowed through into that particular market. And this is the big one in terms of business credit. This is the one we want to be watching over the next couple of quarters. Business credit contracted 0.3 in September, taking annualized growth rate down to 2 from a 2.9% in August. This decline has been the 5th consecutive month, resulting in the lowest annual reading since January 2014. Other personal credit, which includes personal loans and credit cards, has improved marginally from a negative 1% reading in August. It declined a further 0.8 in September. Annually, it's down 12.5%, which is the weakest in history of that data series. So that says to you maybe the Afterpay and these sort of lay-by fintechs are also having an impact in terms of people using private credit. Moving our attention to housing finance, and again, this is definitely the bright spark in the economy at the moment as we round out our observations for this month. The data was released yesterday. We did see housing loan commitments increase by 5.9% overall for the last month, and year on year is 25.5% higher. Owner-occupiers are leading the way with a 6% increase, and year on year a 33.8% higher. So they are leading the way, and first home buyers are playing a big role in that. Well done to you, first home buyers, for getting into the market. Investor lending was up only 5.2% in August, and overall year to date is up only 4.2% year on year. This all points to the government incentive programs are working, such as the minimum deposit guarantees, the home builder programs, the first home buyers grants and incentives at a state and federal level are certainly playing their role in regards to that. The other thing we also want to be watching is the loan deferrals. This was, remember, that fiscal cliff that everyone was scared about in terms of kicking the can down the road. Well, I'm pleased to be able to report that last week we did see a report coming out from APRA that was really indicating that we continue to see the number of declines based on that report, and at the end of September, only 7.4% of the $1.8 trillion in housing finance. So less than 1 in 10 are in any sort of trouble. And I want to quote from that report. Exits from deferrals continue to outweigh new entries for the third straight month in September, with 66 billion loans expiring or exiting deferrals and only 17 billion of entries approved or extended. Now that's on the back of Victoria going into an extended lockdown period. Now this is the important one. Pace of exits increased significantly over the month, with total exits increasing 169% from 24 billion in August. The majority of these loans have returned to a performing status. So that tells you that that is a good news story. Hopefully, with Victoria also coming out of lockdown, we'll continue to see a fall in the coming months. Now, that is my view. That was not part of the statement I just quoted from APRA. Overall building approvals, the data came out yesterday again, seasonally adjusted, shows that the building approvals rose 15.4%. Here's that positive property story coming through again for September compared to August. Now, year-on-year growth is 8.8%. Private sector dwellings, excluding houses, rose 23.4%. While private sector housing rose 9.7% seasonally adjusted compared to August. Now, year on year, here we go. Year on year growth for private sector houses is up 20.7% compared to September of 2019. Private sector dwellings, excluding houses, year on year remains very weak at negative 12.2. So that's the apartment market that we've been talking about. Now, as we round out this update, property market, we saw CoreLogic release their numbers yesterday, and following 5 months of consecutive and consistent declines in residential property values, the CoreLogic's National Home Value Index moved back into positive month-on-month growth through October, posting a 0.4% rise. The lift in home values was broad-based, with every capital city apart from Melbourne posting a rise in values over the month. Now, when we do turn our attentions to Melbourne, we get this data on a weekly basis in our office. We are also telling you that those declines are getting less and less. And we do expect, as we predicted on the Property Couch podcast earlier in the year, that property prices will be back in positive territory by Christmas. Well, our Christmases may have come earlier than had been expected. We did see in Sydney price growth of 0.1%. The quarterly is still negative 0.6. The annualized rate is 6.1 in terms of value, and the overall return still sits at 8.8%. Melbourne showed a negative 0.2 result for the month, a negative 2.2 for the quarter, a positive annualized rate of 0.7 of 1%, and the overall returns when you factor in yield is 4.1%. Brisbane, strong growth of 0.5 of 1% for the quarter, 0.9 for the annualized, 3.5. The story on the ground in Brisbane is very, very strong. So we have seen annualized overall return of 7.5. Adelaide, a very strong number, 1.2% growth in the month, quarterly growth of 2%, annualized 4.4, overall return 8.5. Moving our attentions to Perth, 0.6 growth for the month, 0.9 for the quarter, annualized is now flat. So it's good to see Perth now moving into flat and hopefully growth over a significant period of negative growth in that particular market. 4.3% overall return when you factor in the yields. Hobart had a strong month of 1% growth, quarter 1.6, annualized 6.5, overall 11.9. Darwin, again, a strong month, 1.2%, quarter is 3.9%, annualized is 2.8% for 9.4%. Canberra, another strong month, 1% growth, 1.9 for the quarter, annualized 6.8%, and total overall 11.8%. Combined capitals up 0.2, overall for the quarter negative 0.5, but remembering Melbourne and Sydney make up almost 60% of that reading. Annualized 3.7 and total return 7.1. Combined regional up 0.9 for the month, for the quarter 1.3, annualized 4.8 for an overall return of 9.6%. So that's where we get the overall national number, which is for the month up 0.4, for the quarter down negative 0.1, annualized 3.9, and then total return factoring in rents of 7.6%. Now, what is this on the back of? Obviously, it's on the back of record low levels of supply. Yet, as we were telling you through our data, that underlying demand was there. So even though we had that panic moment through March and April, the underlying demand has been strong, and we're now starting to see that come through. Clearance rates in in Sydney, we did see push through that 70% mark. That was in the last couple of weeks. That's very, very strong. Housing is outperforming units, and this is on the back of basically unit stock being predominantly rental stock. So that's why we're definitely seeing some challenges there in terms of rental appreciation and demand for that product at the moment. The cheaper end of the market is definitely benefiting. So even though we have seen rises across all quartiles in terms of value, but there's definitely higher growth at the moment in the lower value locations. Now, this is that rising tide lifting all ships, and it is a product of low interest rates, which means improved borrowing capacity. So we are definitely believing that we're going to see sort of outperformances in that sort of lower end of the market in terms of percentage gains as we move into 2021. And that is the news story, that 2021 will definitely see property prices perform quite well. Still some headwinds, still some risks. So we do need to see, what sort of businesses are going to survive. We obviously need to make sure we keep on top of the health crisis. So there's still definitely some risk there, but overall, we're probably a bit more bullish than we are bearish when it comes to the property market in regards to the outlook. So as I summarise the November RBA and economic update, I wanted to close with one final comment that I saw in one of Governor Lowe's speeches. And he spoke about how confidence in the health situation and the future state of the economy would be the most important determinants of consumer spending and the shape of the economic recovery. Now, what he's basically saying there is that, because there is no truer statement, if we can keep on top of the health crisis and we can get out and we can have confidence in going about our day-to-day lives, then the economic recovery will be good. We will be able to get out there and we'll be able to start spending. So here is my messages. In terms of on the health front, please do the right thing. If you're not feeling well, or if you're showing any symptoms at all in regards to fever, cough, or just not feeling well, go and get tested and isolate yourself, because what you're doing for yourself is also potentially going to help others. So that's important. If we can get on top of that health crisis, we're going to be well served, because we as a nation are in a great position. In terms of on the economic front, we all need to do our bit. We need to do these critical things. Buy Australian. Go out and see Australia. Go and visit your regional areas where you are able to visit, because it all does come down to being able to, if you can afford for some discretionary spending, that little bit of extra spending that you do today and over the course of the next couple of months could keep a job, or it could create a new job. That is going to give also businesses confidence to know that the consumer is up and about, that business will then start to make those investments that it needs to do. So we are all in this together. And it's about us walking the walk and talking the talk, ensuring that we don't see any of those large outbreaks in the virus, and all Australians go about doing their everyday thing. and we get back to whatever this post-COVID life looks like. And so that's my message. If you've got some money, get out there and spend it if you can. If you don't, that's understandable. But those will create jobs. It'll bring back the confidence and the investment that we need to create this economic recovery. Because at the end of the day, the economy is only a read of our behaviours. So until next month, remember, knowledge is empowering, but only if we act on it.